Welcome to another Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week is Chris. Chris, I think we're getting a lot of questions on, have we seen the bottom? We're halfway to the top, or where we were. Hopefully we can bring some clarity. I know it'll probably be as thick as mud, and who knows if we can actually see the bottom by the end of it. But I think we can also kind of go over where we are in the market.
It's actually a pretty good time to be a technician. There's a lot of interesting things happening on the charts and a couple patterns I wanted to point to. So looking back, we really see a few economists lately have been talking about all these distortions that happened in 2021 and making comps really difficult, comparing quarters if it happened last year. And I can't think it's harder to find a slide that shows that better than looking at a long-term trend.
Right.
So I pulled a 5-year chart of the S&P 500. I only added two things to it. I added a channel showing the general trend that we've seen over the 5 years.
Which is the two blue lines.
Right. And then the blue line that tends to be in the center of that is average prices going back 200 days. 200 days simple moving average. And you can see that simple moving average spends a lot of the time right in the middle of this uptrend until 2021 when things got distorted and it really prices blew out to the upside. And at the time, it made sense. It was unprecedented monetary policy supporting stocks and the economy. But a lot of that's come back out now.
Right.
And the Fed's tightening policy. So we did see a return back into this channel, if you want to call it something more normalized pricing. And now prices are right back at the top side of that, really questioning the same thing. Is the Fed here to support us with monetary policy? If so, potential run up a little bit stronger. If not, probably pulling back. And probably the final thing I like looking here is long-term numbers that you've been calling for a while, which shows long-term value at 3,500 on the S&P and even below our channel at 3,200. Prices that would be pretty difficult to buy, but on the way down and looking long-term, those would be good entry points.
So when I look at this, I see that we've spent a lot of time above that top line, or where you could say that the market was overvalued as the future became reality. But there's also that small dip. And what I've always known in the markets is there's mean reversion. And what I mean by that is if you spend quite a lot of time way above the average and you got to get to average, you got to come back way below the average. But as much time as we spent above the line, I notice there's not as much time below the line or out of that channel. So I think that's just one more thing is like we got to continue to look at these price points. Yes, we would find it attractive at 3,500 for sure, but if we're below that, around that 3,200, you're not going to get much time down there. So that would be a very aggressive buy signal from this channel because it'll revert to the mean again, and we'll get back to that average channel unless there's been some difference in the economy that's made it a new type of economy, and all of a sudden we can have an elevated channel. But I think that it's a great way to look at the market and say, hey, we were overvalued for a while.
And people make fun of these technicals from time to time, right? There's, what was the old line? Astrology for adults.
Yes.
We did a whole technical show on that one. But last week we actually had that 200-day moving average again came into play last week on the 16th, where prices intraday got within a point of the 200-day moving averages. And a lot of technicians, a lot of traders are putting in their orders right around here saying if we break out up, they want to buy. If we break low, we want to sell. And the market just got totally denied right at that price point. Right. And within 30 minutes, it dropped almost 1% on the day.
Right. Academics will kind of make fun of technicals all the time, but in reality, all the people that are in the market, we're all shamans of the market, so we're reading the tea leaves, we're putting these in. Maybe it's self-fulfilling prophecy. I know that we had a rule that if we got in above that 200-day moving average, we would find that as a good place to start filling some cash hubs back in, raising some cash because of that valuation, and we've been spending down that cash for quite some time. So it looks like a couple of people got ahead of us, and we're a little bit early relative to ours, so we never got to pull that, but we're still looking at that, as is the rest of the market. So the technicals certainly matter.
And the last chart I wanted to pull was a retracement chart. So you take Fibonacci retracement, which is sequences that are commonly seen from highs to lows on where the orders get filled back in. That's a 38.2%, 61.8%, and of course the 50% retracement,
right,
which happened last week at 42.20 on the S&P 500. And believe it or not, there's never been a bear market, so peak to trough of more than 20% drawdown, that filled 50% back up and went back down to test new lows and break below those lows.
Right. So
it's always gone on to new highs in the cycle.
So if you covered that 50% retracement, you're always going to make new highs historically. You're never going to go back down and test new lows until you've hit that new high.
Right, and that doesn't mean the market goes straight up after that. It just means it hasn't historically broken back the low that was put in, and that's shown in this chart. This pulls the last 15 times that this happened. And to the right, where we're looking at the 1 month, 3 month, 6 month return after the 50% retracement was in, the 1 month median return is actually negative. So it's not saying we're just going to go off to new highs. There could be some downside, and there are plenty of periods in the 3 and 6 month that are negative. But in the long run, we have not seen a 50% retracement go back and make new lows for the cycle.
So if we were to stop this call right now, based on technicals, which have historically been accurate, and it could always change, it would say, hey, we're going to go to new highs now. We've seen the rough. Yeah, there's going to be some trouble. We certainly can go down lower, but we're not going to get to those previous lows without making new highs. So then that would be bullish. But there's more to it than that, right? We're always looking at several indicators, our watch indicator. One here is the yield curve. And the yield curve is just measuring the difference between how much you can borrow at 10 years versus 2 years. And there should be a higher amount that you're going to pay to borrow 10 than 2. But when that inverts, that's always a signal that the recession is going to happen. And historically, like technicals, it's been accurate 100% of the time. Now maybe we'll come back after November and define the last 2 quarters of recession, and all of this can be true. We can go on to new highs, and we've already had the recession. But this is troubling to see it this low for this long. And right below that is the money supply numbers, which we saw data really changed in 2020, and it's not unprecedented to see central banks and governments of central banks change some of the rules on the way that they calculate money supply when you have a rapid increase like we did in 2020. And a lot of times that data could be, I would say, massaged in a way that shows up like the numbers are showing lower growth. So that may not be that we have low growth or negative growth in money supply, and maybe it's actually positive, and that's why the market's responding. I would say with quantitative tightening, it's more likely than not that we are seeing some pullback. So that also would be a warning flag.
And that's that green line. That's this year's growth is showing down, at least on the indicator. And the yellow line is a composite of the last 12 years, showing that there's some seasonality coming down.
Right.
But around this time is typically when you see the growth to come back, and we haven't seen that.
Right. And then we look at high yield option adjusted spreads. And what that is saying, bond markets probably is considered the smartest money, and they will go into high yield, which is a little bit more risky of a bond. And if they think that these are strong companies, the recession isn't coming, we'll see yields on high yield come down relative to just investment grade bonds. And we definitely saw a spike, but we've retraced some of that. So we're a little bit higher than we've been for some time, but it's good to see that come back. So that would be a positive sign.
And that makes sense because high yield bonds is often correlated with equities.
Yes.
In the last 2 months, we have seen this 12-15% move in equities. Same thing has happened with credit bonds.
So bond markets right now are not signaling a recession. And then if we look at the fear index, that's a way of looking at options, and it's really comparing the 30-day futures to the 90-day. And if the 30-day is higher than the 90-day, what it's saying is there's more concern in the short term than the long term. And what we'll tend to see is a big spike over that green line, and I like to call that the puke point. That's whenever everyone's throwing the towel in, they think it's just horrible, and they're doing anything to offload any equity risk, and that's the time to buy. And as volatile as it's been, we've seen that the fear index has actually been right around its normal trading. We haven't seen that puke point. To me, as kind of looking at this as a technical thing, says we probably haven't seen the worst of this. And then if we look at GDP now, we all know that the last quarter came in negative. There'll be they'll relook at that again this week, is it?
I think it's Thursday.
Thursday. And then we also see that it's starting to decline for Q3.
And this has been a very accurate predictor of first quarter and second quarter negative GDP.
Right.
This model was predicting those.
So if it continues to decline, we could have a third quarter of negative GDP. I think that would be hard to claim. I'm sure it would still be claimed that there's no recession. And then when the bottom one is an econ pie, it really gives us a lot of indicators, leading indicators, and we see most of them in that decline quadrant, meaning that when we look at these leading indicators, we're still not out of the woods yet. So the technicals with the 50% retracement says going on to new highs, but we still see some warning flags. So that's why we would be cautious and say you don't want to get aggressive and go too far out on your risk here just to try to capture some upside, because we may still have a bottom to be placed. Gets us to the Fed meeting, right? And a lot of that, I'm sure they'll be talking about this. I'm always jealous whenever they're at Jackson Hole. It is so beautiful there. This is the Kansas City Fed's hosting, and Powell will be talking there. Now, what do you think the market's expecting?
So this is Friday. It's a few day long meeting, and it is not one of their official FOMC meetings. So the market expectations are all just about rhetoric. They're not expecting any big changes in policy. It's really not the time to announce those. But they're going to be looking at, the market's been pricing in next year that they're going to start cutting rates, and all of the other FOMC members except Powell have been coming out and saying that's not true. So I think they're going to be pricing in, well, what is he saying regarding that? Does he outright say that's not happening? Is he concerned with the slowdown in the economy? Those are the kind of things the market will be looking for.
And kind of a little bit of a dictator, right? He gets to determine what it is or not. They can have different opinions and try to influence him, but ultimately, from my understanding, he's the one that makes that decision as the chair. Another thing that they'll be looking at is inflation, right? We've seen the price of gas come down over the last couple of, 2 months or a month? We've seen, but it's been declining. I'm not paying $4. I'm paying somewhere in the $3s, sometimes even a little bit lower. I know some other states are worse off than Missouri. But if we look at the demand for fuel, it's not changed. And the supply's been fairly steady as well, at least let's say production.
There you go.
So production's been fairly steady as well. So why are prices coming down? Well, back in March, the Biden administration started to release 1 million barrels per day out of the Strategic Petroleum Reserve. And we've been going on, and it continues to go on. I'm sure it's just a coincidence. It ends right around the time the election happens, but that probably has been the reason that we've seen prices decline, is here. And really, we've spent so much of that down, it's going back to the 1980s. Now, this could actually be quite a boon for the government, because a lot of that could have been filled during COVID, whenever the oil was trading at negative dollars, right? So they may be making a profit, and they may be able to fill that back up. But once the supply comes offline, if demand stays the same, I would expect to see prices go up. And if they started to refill that, then we could really see prices move. So inflation certainly has eased here, but we have the potential in the near horizon to start to see that to move back up again.
Everyone knows that the Petroleum Reserve is made for election cycles, right?
Right.
Release them right before. It's been working, so. But like you said, it is a big risk, because the market's been seeing inflation come down. The headline numbers, core has been pretty stable, and we get another PCE read this Friday right before Powell will be speaking as well. So if you start seeing those headline numbers come back up and core not coming down as much as you'd like, there is could scare the market a little bit.
And just to be partisan, I remember the Bush administration using the Strategic Petroleum Reserve as well. It is, like you said, it's great for elections. But to this point on this slide, demand destruction, it just hasn't happened. So it is most likely the SPR, the Strategic Petroleum Reserve supply, that has been helping keep prices down for the near term. And maybe things change around the election, and who knows? Another thing that on data, so we had talked about money supply, we've seen that change, and we're trying to understand what's happening there. There's some questionable data here on unemployment. I'm not saying that anyone's saying any lies. It's just they're a tale of two surveys. If we look at headlines, we see a lot of corporations laying a lot of people off.
Or now, freezing.
Or
not hiring
freezing
anything, right?
Some of that makes sense. Walmart, Amazon, etc., they had a big need to hire people on because of the work from home phenomena that had happened during COVID. Some of that's come back off, so maybe you don't need the employment, maybe you freeze hiring, maybe you lay people off. So there's an explanation there on why companies are letting people go. But we're also seeing very big numbers for job creation here recently. So those are kind of at odds, as well as initial claims increasing. Now, I'm not saying it's record. It doesn't look like the recessionary numbers where you start to really see unemployment go up, but those initial jobless claims are going up. So there's a lot of tension with trying to understand how is all of this true. Now, one thought is that a lot of those jobs may be second jobs where people are dealing with inflation and they're just going out to add additional income to the home, and that may be what's driving the BLS numbers,
Right.
which are saying, hey, jobs continue to increase. But if we look at household surveys, we get a different picture. If they call up and they say, well, what's employment there? That's been very flatline. So there's been this divergence ever since really March between the household survey data and the BLS data.
Yeah, so they added over 500,000 jobs last month, and everyone's wondering how does that happen? And like you said, that establishment survey asked corporations, did you hire? So they can grab, yeah, we hired 2 people. And that one person may have taken 2 jobs, and that could count as 2, versus the household survey, you call and ask, are you working? Yep, that's just 1. So that's kind of that disparity that could be happening in the data.
Right, and so it may just be that, a discrepancy. It's that both of them are 2, and it's just we need to understand a better narrative that explains why both of them can be true.
And just, I know that oftentimes when you don't believe the numbers, it sounds like you have your tinfoil hat on, but if you read the FOMC minutes that got released last week, they said actually several members of the committee also saw this and were confused by it and said, you know, for a while, the Fed's been saying how strong and how tight the labor market is, and they called in the question, well, maybe it's not as tight as we're seeing.
So maybe we'll get a little bit more clarity out of Jackson Hole on what they think is, and that'll affect interest rates.
But it's really staying here, just stay domestic.
Yep.
International's not performing well. Emerging markets is at the absolute bottom with a very low reading. Something to keep an eye on too. Right? Dollar's at an all-time high right now. So when that starts to change, you will want some emerging markets back in the portfolio, but not right now.
Another thing is we had commodities at the beginning of the year. It was near the top for quite some time through a lot of the painful inflation that we felt, especially whenever gas was at $4. But we got a rotation. It started to move, and now it's near the bottom of this stack. So that moved us out. We do still have some exposure, but it's not in commodity futures. It's in commodity producers. A lot of those PE ratios look pretty good, and their earnings should be fairly stable. We're just not seeing that price increase in the actual physical commodities. So we've made some of those changes in there as well. Well, we really appreciate you joining us on this call. If you haven't subscribed yet, hit that subscribe button. And if you just like this presentation and just the way the new setup is, hit that like button, and always feel free to hit that arrow to share it with your friends. We hope to see you here in 2 weeks. Thank you.